Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Raymond Sheffield, who I'm just going to call Ray. And Ray is an attorney specializing in trusts and estates, and he has his own company, Sheffield Law Office, in San Jose, California. Ray has been a lawyer for 13 years. He received a JD degree from Santa Clara University and an LLM degree in estate planning from the University of Miami in Florida. And Ray tells me that he just loves the role of counseling clients for their estate planning. In addition to his law practice, Ray is an adjunct professor in the Golden Gate University LLM tax program. Ray and his wife live with their two adopted daughters, ages 6 and 8, who are from Russia in Almaden Valley in San Jose, California. So Ray, thanks for joining me as a guest today.
Thanks for having me, Mike.
It's a pleasure. So today, Ray and I are going to be talking about charitable remainder trusts. And before we get started, I am going to caution our viewers that we are discussing issues in a very complex area. This is a starting point for a bigger discussion. We want you to get qualified legal and tax advice. Also, we're mostly talking about these issues from a federal and California standpoint. And so, for example, California has its own flavor of community property. They have community property in some other states, and it operates differently than in California. And other people, separate property. Well, anyway, viewers in other states definitely need to seek advice about their local laws. So, Ray, let's get started. What is a charitable remainder trust?
So a charitable remainder trust is something that Congress and the Treasury Department have carved out through code and regulations that basically allow someone to donate property to charity but retain an interest, usually an income interest in that property, for a period of time or for the rest of their life. And then when they pass away, the rest of the property can pass to charity.
Okay. And so we've got two interests in this trust. So between you and me as practitioners, we talk about split interest trusts, and I think it's actually in the regulations. But anyway, we've got the interest of the charity as a remainder beneficiary, and we've got a lifetime interest in the income for the other beneficiaries. All right, so we've decided to talk about these trusts at this time. This is November of 2013 when you and I are having this interview. So why do you think, or do you think these are going to be more popular if people are talking about this?
No, absolutely they're going to be more popular. In fact,
Okay.
these were very popular in the 80s and the 90s up until about 2003 when Congress lowered income tax rates, especially the capital gains tax rate.
Right.
Recently, income tax rates have been going up, right? And we also have the Medicare surge charge tax.
Yeah.
So because of that, these are going to become incredibly more unpopular as those tax rates go up, because this is a very efficient charitable giving tool that also allows you to save income taxes in how you do it.
Right. So when we talk about the Medicare tax and so forth, I call it the net investment income tax. But anyway, what it means is for very high income taxpayers, they've seen their tax rate for long-term capital gains go from 15% to 23.8%. And that is a really big increase. And plus, with phase-outs, of deductions and so forth, it actually can get higher than that. So, of course, people are going to be looking at, how can I keep some of that money?
Well, and it's interesting that if you look at how many charitable remainder trusts existed in 2003 versus exist today,
yeah,
it's actually lower today, as people have not been creating these trusts when the capital gains tax rate was only 15%. But as the rates have gone up, and you forgot to mention too, but we also had a state income tax increase in California. So, as income tax rates are going up, right, so will the ability to take advantage of this type of trust and make it make economic sense for you and your family.
Right. So maybe you can explain to our viewers a little bit about how does this all work?
So generally, someone is going to take an appreciated piece of property, a piece of property that if they sold it, they would have to pay a substantial amount of capital gain. Most of the time, that property is not producing a lot of income for them. It's producing capital growth. It may be a piece of real estate. It may be a business interest. It could just be stocks and bonds, right? And they put that into the trust. And when they put that into the trust, they can now sell the property without having to pay any capital gains tax, right? Because the trust is now a charitable entity. They get an income tax deduction for the actuarial amount of the property that will go to the charity. That has to be at least 10% when you're doing all your calculations. And they can take out an income interest now that has to be at least 5%. And depending on their life expectancy, the term of the trust and stuff, it could be even more. But by taking out that income interest, they're basically getting the benefit of 100% of their money working for them to produce that income interest, as opposed to if they sold the property and paid capital gains tax, they'd only have the remainder amount available to pay the income interest out to them.
Right. Okay, so what we're saying is, first of all, that when you put this money in, not this money, we're saying actually property, we're saying appreciated property, let's say it's stock. We're in Silicon Valley, so so we may have Facebook stock or something that somebody has had a lot of appreciation on. They can put it into this trust. You get a tax deduction for a portion of it because you have to reduce it by the remainder interest of the charity. And there's actuarial tables that the IRS has put out for that purpose. And but the trust gets to invest all of that money, and then an income stream can come out that can generate income for the beneficiaries. And so how is that income stream determined as far as what's going to be paid out?
Well, it's going to depend on the type of trust that you create. Mm-hmm. So you could set your trust up so it pays a specific sum month after month or year after year, no matter what.
We call that an annuity trust.
An annuity trust, right? Because you're receiving an annuity payment. The more common approach, I think, nowadays for most people is what's called a unit trust, where you pay out a fixed percentage of the trust. So once a year, for example, let's say in January, you determine what the value of the trust is worth, and then you calculate the payments for the rest of the year. So if you're paying 5% and you have $1 million, that's $50,000 over the course of the year, and you'd pay that out maybe over the 12 months. The next year, if your trust had earned 10%, right, and you paid out 5, you'd have 5% left over, so you'd have a little over $1 million, and you would pay 5% of that amount and every year going forward. So when things go better, you make more money. When things go down, you're going to make less.
Right. And then the other thing related to this is that you can also limit the distribution for the year to the net income, right, for a unit trust. So if your net income is less, like the market, tanks, whatever, or interest rates go down, then you don't have to suck out all the capital of the trust if there's not that much income.
No, there's lots of little peculiar things that we can do to solve specific client situations, right? A net income provision would be one. Make-up provisions so that you can pay more in later years is another. Maybe deferring that income interest for a period of time makes sense for some people.
Okay. And now when this income is paid out to the beneficiaries, what's the tax result for them?
Well, unfortunately, what Congress gives with one hand, sometimes they take away with the other, right? So the trust really isn't tax-free when you make that contribution. It's deferring the income tax until you receive the income back out. So there's a rule that's basically says worst out, first out. So whatever is the worst type of income, you pay income tax on that first. That's really no different, though, than if you had paid the capital gains tax and then invested your income, because you're going to pay ordinary income tax the same as you would for anything else. But all the capital gain that's inherent in that contribution is also in that trust. So eventually you end up paying that if you withdraw enough income from the trust.
Okay. So the distributions carry out income, and there's a certain ordering rule, and it basically says anything that's ordinary income, that's the high tax rate income, that's going to be distributed first, and then other types of income, for example, income from a qualified dividend that's subject to a lower tax rate, that would come out in maybe the next tranche or whatever you want to call it, and so forth. So, and actually you can have tax-exempt income that can be carried out too. That could avoid a tax there, but then you're probably getting a pretty low return. So anyway, so is there anything that you want to add related to the basic framework and how this thing works that maybe we haven't touched on yet? Or?
Well, I think, it's important to make sure that you consult with a proper tax professional on this. Don't just go to the charity and rely on what the charity says. Make sure that the attorney and the CPA that you work with are versed in these things and understand the tax implications. There are ways to, I don't want to say manipulate, but determine when you receive income. In some of these trusts, you can do things that give you a lot more control over the property than we've really done in the past. So you want to make sure that you're talking to people who understand how this works, and can they solve the particular problem that the client has for them.
So another thing I think that people really need to understand is the nature of the assets that you put in. I mean, you can have stock and bonds. You could also have real estate. The issue gets to be, though, this matter of valuation, particularly when you have a unitrust. So in other words, if you have more complex assets, then you're going to have a more complex valuation done for those assets.
Absolutely. I mean, stocks and bonds are it's easy to determine what the value was, right? If you have a business, if you have real estate, or maybe an LLC, holding your real estate, you're going to have a little more complex valuation. And one of the reasons you want to work with a qualified tax professional is to make sure that A, that you comply with the rules and get your valuation done properly, but B, to make sure that you can try and make that valuation as high as potentially possible. And oftentimes, because of other things that have happened in the estate planning world that Congress has done, you may be getting a lower valuation through what's something called discounting, which is probably way beyond the subject of this talk, but I know you've done talks on that in the past.
Yeah.
And you don't want those with this. You want to get as high a valuation as possible.
Right. So, and that may have to do, again, with how you structure how the title is being held for property. So if you have a minority interest in a business, then, I mean, that dictates that there probably should be some sort of discounts, and the IRS would be looking for it in your valuation study. So you just avoid having the minority interest. You just own the whole thing if you can.
Now, one thing too, Mike, that people should be aware of is the impact of debt on the piece of property they own. Right.
Yeah.
So if you have a mortgage on the property, you really can't contribute it into the charitable trust. I mean, it's really not suitable at that stage. You need to have the property free and clear for whatever piece that you're contributing into this trust.
Right. When we were talking about easily valued assets, so again, and we say stock, we really mean publicly traded stock. So those have listings each day. You can look them up in the Wall Street Journal, whatever. I mean, that's easy to value. If you had closely held stock, now again we're back to the valuation study, and you'd be paying thousands of dollars possibly to have that done. So, just bear this in mind when you're thinking about what am I going to put in this thing, and try to make life as easy for yourself as you can. Now, how soon should when should these payments be made? You're not going to know you're going to know what the value is at the beginning of the year. So you could compute that, but you're not going to know what the income is if you're limiting to income until sometime afterward when the tax return is prepared. So, you know, how does that work as far as when the money needs to come out?
Well, so there's a number of ways that you can handle that, but when we're dealing with unit trusts, right, you usually pick a date and then you may delay the start of the payment from that date for example, 3 months. It really depends. I think that's a pretty complex question for when the person needs that income. Because like I said, there's some things that we can do now that kind of allow us to have more control over when income is going to be earned, and paid out by the trust and when not.
Okay. Do you want to comment any more on that, or do you want to just sort of leave it at that and say, "See, you're a lawyer"?
Yeah, I think that's good. I think
Okay. Okay, but there are some techniques that are being developed to try to give a little more control about when this cash has to be paid. Okay, now let's hit a few of these other details. Who can be the income beneficiary for this trust?
So traditionally, people have set these up for themselves or themselves and their spouse, right? And the primary reason that was done was because if you make someone else the beneficiary, there's a gift tax issue that had to be resolved. And in the past, the gift tax exemption was only $1 million, and people would have estate tax issues and all sorts of things. So they usually didn't do that. We now have a $5.25 million estate tax exemption. Between husband and wife, then, that means $10.5 million potentially. So a lot of people who don't have estate tax problems still have income tax issues that they're going to want to use a charitable remainder trust to help resolve. And so we're actually finding now that you might actually set one of these up, for example, for your life and for your daughter's life, and then have the remainder interest going to charity. Now, there's some tax issues with that, but it doesn't change the income tax issues. It changes the estate tax issues, and they may or may not be as big a problem depending on what the overall net worth of your estate is.
Okay. Now, how about designating the charity that's going to be the beneficiary for this trust? Are you pretty well stuck with your initial decision, or is there some flexibility about, controlling who can get this later? Or?
I think, in my opinion, it's one of the worst things that we see when we see other people come into our office with charitable remainder trusts. Either the charity that they went to gave them a form that just named that charity as the beneficiary, or the attorney really didn't understand what they were doing and said, "Oh, you want to leave all your money to Stanford? Great, we'll put Stanford in." And they didn't include a provision to allow you to change your mind. There's nothing in the law that prevents you from being able to change your mind, but you got to put it into the trust that you have the right to do that. So as long as the charity is still a public charity, for example, you should be able to switch from one charity to another. People who are in their 60s have oftentimes have a different set of charities that are important to them than maybe they would when they're in their 80s. Or, you might not think that breast cancer is a big issue for you personally until it occurs in your family.
Yes.
And then it becomes a very big issue, and that's where you want your money to go. So you always want to make sure that you retain that right to change those charitable beneficiaries.
So as long as it's a qualified public charity, it's okay. You can have a range that you can choose from, and so it makes sense to provide that flexibility there. You can retain that kind of control without blowing this whole thing out.
Now, you can name, for example, a private foundation as your initial charity. That's going to have some income tax. You're not going to get as big an income tax deduction necessarily. It's going to affect that. And we're not seeing a lot of people necessarily who have private foundations setting these up, this way. But what we do find, if you have a private foundation named, and you can always go to a public charity. Doesn't change your income tax, but you can always move out. What you cannot do is set up a trust that has a public charity to start and take those income tax benefits and then move to a private foundation. What we tend to encourage people to do is maybe look at a donor advised fund or something that allows flexibility there as well.
Right. So, for example, I've had Silicon Valley Community Foundation as a guest, and so you could make the foundation your charitable beneficiary, and they will take a donor advice as far as where that money's going to ultimately go. But you can also just have it in your trust. I mean, again, you could still have.
You could still just name it in the trust.
Yeah.
You know.
Okay. So, who should be the trustee of a trust like this? Is this one that you can be the trustee of your own charitable trust?
I think in most circumstances you absolutely can be your own trustee. I'm going to qualify that when we talk about some of these things where we talked about when you get income and when you don't. You're going to lose, to have that level of kind of control, you're going to have to give up some control as well. You're going to have to create some independence in some of those roles. But for most people, when they make that contribution, they retain the ability to be the trustee. Certainly when they're doing the unit trusts, I find that all of my clients want to have control because they think they can invest the money for even more growth, and therefore they get the benefit of that with the higher, percentage that they're receiving.
Hopefully they're right.
well, that's certainly a risk,
Yeah.
and there's liability concerns
Yeah.
if you're the trustee.
Right.
When clients say they're going to be in an annuity trust where they just get a fixed sum, we strongly encourage them to just let somebody else manage the money for them so they don't have any risk. Because no matter how much that trust earns, they only get their fixed dollar amount.
Yeah.
Now, when you have a charitable trust and you're the trustee, you have certain responsibilities for investing that money that include responsibilities to the charity.
Right.
So I oftentimes hear people say, well, you can put all your money, just invest 100% into a muni bond, right, and everything's okay. Well, what happens like Orange County went bankrupt, 1 year? What happens if, that muni bond isn't earning anything and you're draining the trust?
Right.
And we have had some lawsuits where charities have actually sued donors over how the charitable trusts were invested. So it's something you certainly want to get advice on, but there's nothing necessarily preventing you from doing it. You just got to make sure you follow the rules so you protect the other assets that you have.
Right. I'll just say I've got my own feelings and opinions about this, and that is that I think this is a pretty complex animal that we're talking about, and that I've always had some reticence, I'll tell you, even being a tax practitioner and being involved with them. I've just recently got involved with one of these. I've got an independent trustee that wanted to hire me because he knows that I'm pretty conscientious and had problems before. Well, we spent the last year and a half cleaning this thing up. And anyway, I just think it's a good idea to use professionals on these things. I think that it's worth it, especially if you've got a large sum involved. And maybe you are a very talented investor, and that's cool, but most of us aren't. And so again, if you have a good asset manager that you can work with in the process, well, one, if you can, I guess that's okay. That can help to absolve you right there. But again, by having that professional, because here you are, you're exposed to lawsuit from a charity, and I'll tell you, they look. I have a client that was a trustee for a trust, and Stanford was, the beneficiary, and they wanted the accounting.
Absolutely.
About what was going on. So, so I don't think we can kid ourselves here. And so that's just my own little rant.
No, I mean, you asked about can
can
right?
you do it?
So
Yeah.
yes, you can. Should you is a totally different question. I think you're absolutely right. The cost of a professional trustee is minimal to your income stream, which is really what you've retained. And the release from the liability, the making sure that the I's get dotted and the T's get crossed, those are so important. I don't think it's worth it. We always encourage our clients to use professional trustees, and even if they decide they want to retain being the trustee, we always make sure they work with qualified tax professionals who understand charitable remainder trusts and how the accounting on these work. And the cost on that isn't that great either. But it's not something that your average CPA does on a daily basis, and therefore they can make mistakes, and mistakes can get really costly.
Right. Well, we just have about a minute or so left, Ray. Maybe you'd like to throw out some final thought on this area of using this charitable trust.
Well, I think anyone who has a piece of appreciated real estate and wants to leave something, maybe not 100% sure, but wants to leave something to charity, should be thinking about whether a charitable remainder trust might make sense for them, as they want to convert that capital asset into an income stream at some point down the road. And you don't necessarily have to wait till you retire, till you want that income stream, because you may be able to do it now and defer that income stream until you need it later.
Okay. So again, this is something that you might investigate. There is new thinking that's happening in this area. And again, especially if you're an upper income person, or let's just say you're really asset rich, and maybe you're not so income rich, but you could convert some of those assets into an income stream. This is something that's really worthwhile thinking about. So, but you remember, the charity is getting the assets ultimately, so it's not something you do lightly. All right, folks. Well, I hope that we've given you something to think about, and a little more complex area. We'll see you next time on Financial Insider Weekly.